So let's get started. Generally, welcome everyone. I think most of you guys know me for the most part, unless you're brand new and have never seen me before. Um, so again, this is just more or less question and answer. You can even ask me about my business if there's something particular you want to ask. Feel free, and we'll just kind of make this a free fall for all for the next hour. We can go any direction you guys want to go as far as questions go. Anything you're looking at that you want to talk about that you don't understand, any advice if you're having problems dealing with a particular situation, such as a broker or anything like that. So we'll go ahead and get started. It looks like Mark has his hand up already. Go ahead, Mark.
Yeah, listen, just to kick things off, we hear you guys talk often about, when you're in the heat of a transaction and the owners might take their foot off the accelerator,
Mm-hmm.
and you might have like erosion of top or bottom line in the business. Um, can you give any color on how do you salvage it? If you're, looking at making a case to the bank that we're going to grow this thing at, 10, 20% a year, but they're staring at a 5 to 10 or 15% erosion at the point of the transaction. What's the storyline for going through? Because I've heard you talk about like you have salvaged those deals before.
Mm-hmm.
What does that look like? What's the case for that?
So, I mean, a situation where you're buying a business and during the transaction, you see a severe drop in cash flow or the bottom line or revenue drop significantly. The first thing is you're going to want to alert the lender to the situation right away. Some lenders are going to require one or two things are going to happen. Lenders either going to request that you go back with different terms on that particular deal because they're probably going to lower the actual lending facility for you to acquire the business, and or some lenders I've seen just kind of get nervous and just drop out. So the way to salvage it on your end, and actually I would probably do this even before I even went back to the lender to alert them of the situation, is I would actually go back if it's a severe drop, go back, readjust the terms of the deal. I mean, I wouldn't necessarily. Sellers hate to hear the total price drop. Like, hey, I'm gonna scale the value of this thing down $1 million. They don't want to hear that if you've already agreed to a price. But what I would do is, number one, get an explanation from the seller as to why the drop. Was it like due to a key customer? Was it just they've had a downtrend in the industry because of some exogenous event that happened? Try to understand why the drop. And then, generally what I would do in a situation like that is keep the price the same and just go back and adjust the terms and maybe build in a forgivable note structure. Hey, I'm still willing to give you, let's just say $3 million for the business versus $2 million for the business, but these are the terms and this is how it's going to have to work. I'm willing to give you kind of the base value, 2 million. Maybe you're gonna give them a 10% note or 15% note on that $2 million, pay the rest in cash. But then the balance of that structure should be then structured as a forgivable note under those certain targets. I found that particular approach works well with sellers, because if they think it's temporary and it was something that just was a freak of nature from their perspective, then they're going to have faith that the business is going to come back, and they'll be willing to kind of do that deal, and realizing that they'll end up ultimately getting their full value. It just may be over a longer period of time because of that drop. If they're not willing to do that, that's a red flag in your head that tells you that they even think that the business is probably fallen off a cliff for whatever reason, and it may or may not come back, and they don't want to take that chance, and they have no faith in it. So why should you have any faith in it? And if that's the case, then I would definitely retrade the price all the way down instead of just restructuring the deal, and then resubmit it to the lender and let them know, hey, this is what happened. I'm probably going to need a smaller loan because I'm buying the business at a reduced price from that standpoint. But I think the first point of the way to handle that is to just have that general discussion with the seller and find out what specific reasons did the business fall in terms of its performance, and try to assess whether their answers make sense in the totality of everything that you know, or if it's a bunch of bull and they're trying to pull the wool over your eyes. And that's how you first should start handling this thing, and then you can talk about structure after you get to some confidence level based on what they've said.
Yeah, that's great advice. I think the takeaway is that that's not necessarily the end of the deal. There are routes and avenues to salvage it, which is helpful. Thanks for that.
Yep. James.
Hey, Rich, how you doing, man?
Good, man. How are you?
So my deal came back, the one deal, e-commerce deal. So he came back to the table. He walked away for 3 months, came back. We're back under LOI. It's kind of to Mark's point. So we came back. We got the actual numbers, right? So we went back under LOI at the original deal, right? He had his accountant. So I had a QOE, right? That came back, put earnings at like 1.1 million, right? Where he was representing like 1.8, 1.9, right? So he didn't want to hear. Yeah, it was significant, right? So he ended up walking. So then he had his accountant go through and do everything, I guess, right, during this time. And then I ended up just reaching out to him and was like, hey, whenever you're ready to sell, I know you got to sell eventually, right? Just let me know, right? And he was like, hey, yeah, let's have a conversation. Because I wasn't sure. I knew that this deal was going to have to be retraded, and I didn't know how that was going to work. And then he walked, right?
Yeah.
And then he came back, and then his numbers looked just like my numbers, right? Like I never showed him the numbers, right? But he got to the same conclusion I did. And I kind of, he was kind of hard set on his number and what he needed to walk away with. And so I kind of painted the bank as like it was. I walked him through the debt service coverage. I was like, listen, this, I didn't want to do this because obviously I want my debt service coverage to be as high as possible, right?
Yeah.
So I wanted to avoid this at all costs, but it was the only way to make it work for him, to make him understand it, right? I was like, listen, this is what's required. This is what a bank is going to lend on, right? So like with these earnings, this is what I can get. Right.
Yeah.
And then this is the gap that you're going to have to carry. Right. And this is what we're just going to have to let go. You know what I mean? Like this amount we're going to have to let go. We ended up adjusting the price by $2.5 million. Right. And the only way that he was able to get there was kind of through that transparency. Right. And then him probably talking with people that he knows that, whatever research he did. But so now we're back on track to kind of, we're back rowing on the same side of the ship, right?
Yeah.
So before we were kind of adversaries, like, oh, well, he thought that the whole point of the QOE was to kind of screw him over, right? He was like, oh, you're just trying to find a way to retrade the price, right? To kind of give me not what we agreed to, you know what I mean? I was like, that's not at all. I want to give you as much as I possibly can. I really like this business, right? Like I want to give you, and I'm paying a 4.5 multiple, right? So it's like I'm giving him full rate on what it is, right? Now we've got unique structures in there that that gets the debt service coverage. So we got a longer amortization on the seller note, interest only for the first 2 years. We've got a standby portion, so it's like he was able to get creative to kind of get where he wanted to go, but. So to Mark's point is like, how do you get there? You got to get the seller on your side, right? So it's like if he's not on your side, right, and you guys are kind of like across the table and you're enemies, never going to work. You're gonna, he's going to walk, or you're going to walk, or the bank's going to walk. And I did that by kind of pinning the bank, like, listen, the bank has the money, right? Like I don't have the money, the bank has the money, and this is what they need to be able to give us that money, right?
Yeah, and I think. That is a perfect illustration of how to use the QOE to your advantage. But it's almost like, so the first situation that I described was, let's just say it's post-QOE and performance has dropped, and you're trying to figure out why the current year performance has dropped, because the lender is going to want to understand that before they issue a loan. Your situation is before you've even gotten to that, you've had to they had to reevaluate kind of what the true cash flow of the business or earnings are of the business, and based on what they initially said versus what came back, it's completely different. And in your case, that is the perfect solution in order to kind of to actually continue with the deal, or to try to get them to continue moving forward with the deal, given the substantial delta in what you assumed were the cash flows of the business versus what they actually were. And I think in that case, transparency from that standpoint works perfectly, because I think if you can walk them through exactly kind of the change, this is what you said, this is where we're at, this is what the lender's willing to do. Hey, I'm not the bad guy. That works in 90% of cases, because I think even sellers understand that, look, even if I go out to another buyer, they're going to see the same thing.
Place.
Lenders are going to see the same information, and they're probably going to get the same terms. So, I understand this guy's not really trying to screw me over from that standpoint. So yeah, I think he handled that perfectly from that situation. And I think Mark's situation was a little bit further down the line, his scenario, but I mean, ultimately it comes back to the same thing, getting the seller on your side, having that discussion with the seller, making them understand, hey, I'm here to kind of help you facilitate the transfer of this business, but at the same time, let's be realistic about kind of what's going on in the business right now, and let's be realistic about what you represented as your cash flows, which aren't really your cash flows. So
yeah. And so in the beginning of this deal, so this deal started in February. Okay, so here we are 8 months later. And in the beginning, the one thing that because I had learned that through Acquire It, the whole sellers take their foot off the gas, they kind of get a little complacent, they're trying to deal with running the business plus, checking out or whatever. And I was just like, in the very beginning, I was like, whatever you do, don't take your foot off the gas, right? Like focusing, like in the beginning, even in our initial, as soon as we went under lie, I was like, the most important thing we can do is, run the business first. Now, obviously, if it's out of his control, right, whatever, right, if it's market and he can't or whatever, you know what I mean? Like, who knows? I mean, I hear a lot of businesses are down this year, right? So it's like at least 10%. 10% is being generous. I mean, just overall market, depending on what the industry is, right? So I think that the seller's going to know. They're going to know where they're at, right? They're going to know if they're down 10%, if they're down 15%, right? So it's not like when you bring that up to them, it's going to be a surprise. They're going to be like, oh, wow, I didn't know that. You know what I mean? Like, well, that's crazy. How did you, but again, and then as long as you anchored it to a certain valuation, or depending on how you got to your multiple, right? So anyways,
Yeah, I think that's right. And I mean, they're going to be passing information on you, so they obviously see that they're down 10%. Now, it's just a reason of why
they're
are
thinking,
down 10%?
yeah, and they're thinking, oh, 10%, it's only 10%, right? Or that's nothing or something. But
now, what I will say is, now the rates are starting to come down a little bit. I just checked this morning, and the max SBA rate is now come down to what, 10.75%, I think, something like that. So you're going to start to see elevations in values of these small businesses. Even if they're down a certain amount, they may hold value just because rates are coming down a little bit more. So, just consider all that as well. Dave, what's up?
Yeah, so it's almost it's very similar to Mark, and a little bit flavor from James's questions as well. So doing pre-LOI due diligence for a company. I'm trying to move really quick. In fact, I'm meeting with you guys on Tuesday in the IC to kind of walk through it. It's pretty exciting.
Oh, that's right. Yeah, I saw that.
So I have everything. I have tax returns, P&L, you name it, outside of the balance sheet. So on Tuesday, I did reach out and say, hey, I need a balance sheet, kind of driving into the details. Everything else looked great with the business. The firm primarily deals with both federal, state, and municipal contracts, so it's heavily involved on there. They do a splash of commercial, I'd say about 30%. So, of course, like a lot of these places kind of dipped in COVID, they've rebuilt. Things are really good. So the broker worked with them to evaluate really using a 12-month trailing TTM.
Mm-hmm.
They projected they were right around about 800,000 for beta. So, hey, that's great. No debt. Life is good. But because they deal with a lot of these state local contracts, they've had some delays over the last couple of weeks, and it looks like that might push into about 2 months. So I wanted to see the cash flow for a lot of that type of stuff. So chatting with the broker this morning, he came back and said, hey, after we refactored this stuff, we're really tracking at about 471,000 for EBITDA, which is a pretty significant drop. And so
that's like half.
yeah, about half. As they're kind of like projecting this out, I'm like, this is kind of wonky. So he's working with the owners. They're going to come back on Monday and say, hey, are they happy to reduce the price that basically refactor?
Well, wait a minute. So
Okay.
was the cut due to just the delay by 2 months?
Yeah, by 2 months, and that didn't make sense to me how 2 months would decrease by half, right?
Unless unless it was backloaded
Large
into
contracts or
those,
something.
yeah, it was backloaded into those months.
And
so
is it getting pushed into
say-
2024, or is it just gone? Like,
they're still there. They're probably going to restart mid-November to early December. And I guess the other part of that too is they found through kind of cleaning up their side, they found they were short about billing quite a few or a couple milestones. So that's, I think, where that refactor comes from. So
okay, but they
Yeah.
can actually get to the full value by now. So in that situation, and I don't know what your question is, but I'm gonna kind of just jump in right now.
probably
But
know where I'm going.
yeah, in that situation, I don't know necessarily that you want to drive the price down that they're asking for in context, because I would want to understand how they did the full year in 2023,
Yeah.
how they did the full year in 22. Maybe I consider 21, but again, those are wonky years. 20 and 21 are kind of wonky years, but but if they've got if they were doing government work even at that time, they probably had a pretty good business in 21 as well. So I don't want to understand kind of where they are in context of those years, because the TTMs can be funky because of that trailing, the anomalies around there using trailing 12 months, because if those forward months are off, or the 2 months that you start with are like way off, it makes that whole year kind of off in relation to where it would be on a normal annualized basis. So I would want to understand kind of the at least the prior year and the year before that, to see where they were and see what that normalized number looks like in context of where they are right now, because it could be right that number will come back to 800,000. It may not be that the business is worth only half just because of the trailing 12-month number. It's almost the same thing that I always tell AEs all the time. I would not just value, if some sellers coming to you and they're valuing their business, just offer the trailing 12-month or 1 year's worth of data. I would be leery of that, because they could have had their best year ever, or they could be in the midst of having their best year ever, but the prior years were crappy, and now they're trying to get full value for the business. It goes the same way. When you look at it the other way, I would be leery of docking them just because of where they are in 12 and 12 month. Now, in my head, I'm thinking, is this a trend?
Right.
But I would be wary of outright dismissing their value because of the trailing 12-month number. Until I can kind of understand where the prior couple of years were. And if the prior couple of years were down, and all of a sudden I see this number that kind of matches them, and they're telling me that, well, it's going to be $800,000, then I'm not going to take them at their word for it.
Yeah.
But in a situation where, let's just say they were at 800,000 for the other 2 years, and they're just at $400,000 now because it's there's a delay in the deal, but they know it's coming back or what have you, I would probably be okay with their value. Now, I may build in some protections in the structure just to make sure that we get there, if based on the timing of actually acquiring the business. But at that point, I'm kind of like, okay, that makes a lot of sense, so I'm okay from that standpoint.
Yeah. No, that was a flag kind of going off my head. So I looked at COVID. They did fine. 2022, They did okay, and started really aggressively, almost doubling EBITDA in a lot of ways. But kind of looking at last year, their EBITDA I think was probably sitting around mid fives. So maybe this is truly where they hover. It was going to be their all-time year, right? And they're like, cool, let's sell. And I was like, dang, these contracts are slipping in. And that might have happened last year too. And I'm like, well, this is a trend. Okay, we got to build in that buffer of some slippage, with exception of the unbilled AR and whatnot. So,
in this case, I would actually, on a deal like this, depending on kind of the timing of how this works, if I looked at their last year and they're at 500 and they were supposed to be on track for 800, let's just say, and all of a sudden they kind of revise and come back to about 475 or whatever that number is, then what I'm gonna assume that the business is kind of, let's just say, normally at around 500, 600, like you said, and this was going to be their best year. Well, I might still structure a deal at 800,000, but I'm going to structure it with, hey, if you don't hit 800,000, then I'm going to pay you the value of this deal based on 500,000 or 600,000 versus 800,000. If you hit that, then let's talk about it. Then maybe it's worth it. That way you're kind of protecting yourself from that standpoint.
And that would be under like performance-based bonuses and all that stuff for the seller.
Yeah, you can do it on performance-based bonuses, forgivable note structure. You got to be careful. Can never use, earnouts with the SBA, but there's language and structures you can use that get you to the same ends.
Yeah, no, that's fantastic input as I'm going through this stuff. So I look forward to it. Thank you.
No problem. All right, who's up next? Anyone?
I would love to hear about I know you bought, when I had first started Acquira, you had bought a machining business, I think, or you had just closed on it, or you were like closing on it. What is that? I don't know if you could speak to your experience in machining, is it something that you had experience in? And then obviously you're not running it, right? And you're doing Acquira 150%, 150% time in Acquira, and then I'm assuming it was a multi-million-dollar transaction, and it's not even where you live. So how does that look for you? And how's it going? And how's that going? I guess so. This is a whole.
For some of you who don't know, James has been around for a while, so he was kind of here when I was in the process of buying it. So I bought with a partner. It's probably been about 2.5 years now, I want to say. I bought a printed circuit board manufacturing company. Actually, it is located near me out here in Arizona. I'm actually there Wednesday mornings usually, either working with the management team, dealing with management issues, I like to say I'm there dealing with management team issues and exerting some leadership. My partner would tell you guys I'm just there getting in his way, wasting time. So, we bought this company for roughly, I think, $9 million at the time. Bought it with a family office partner. The idea for us to buying that business was they build these printed circuit boards for specialty manufacturing equipment. So most of our customers are other manufacturers with specialized equipment. And so a lot of it's custom designed especially for equipment that is I would say, I don't know what the right word is. It's been customized. We'll just say that, customized equipment. And so our idea was the previous owner had owned the business started the business roughly 20 years before that. And so our idea was, hey, if we bring in a business development guy, and most of the business was local, Arizona, Southern California, Nevada, Southern Nevada, New Mexico. And our idea was hey, we can bring in a business development guy. There's no, as far as shipping was cheap. If we could build this business, get some national headway with some of the other national manufacturers, or in fact, manufacturers throughout the country, we could actually blow this thing up. So that was the kind of the thesis of why we bought the business. And it's been interesting over 2.5 years owning this business. Before I bought this business, I was more of a spreadsheet jockey. That's just my background. Just if we cut costs here, we grow here, our returns are here. And I always looked at everything from an investor standpoint, didn't necessarily look at it from an entrepreneur standpoint. I understood what we wanted to do. My partner that I worked with played football with me in college. So he's a longtime friend. He had gotten his MBA from Stanford. So smart guy. And he went into operations for GE. So I knew he knew manufacturing pretty well. So the idea was for him to kind of run the business, for me to run the finances, run the money, the finances, and then any future acquisitions, obviously I would take the lead on to kind of build the business. 2.5 years of working in this business, I understand what a small business entrepreneur has to deal with. People not liking each other, gossip, you know, stupid internal fights over the coffee machine or whatever. It's been a learning experience from that standpoint. And luckily, he deals with most of that stuff day to day. I'll show up and try to get my 2 cents in. Everyone knows who I am, but everyone looks at me like, you know, like I'm an alien. Like, what are you talking about? What are you doing here? You're not here all the time. So we know each other. They know me, and we like each other. But it's at the same time, I'm not spending every day there like he is. So it's been an interesting ride. Our family office partners have definitely stepped up to the plate. They provided most of the capital to buy the business. They put in pretty much $8 million. It was one family office that we've done some business with in the past, and we put in. Me and my partner, I put in up to about, I think I put in 700,000, and he put in the other 300,000. So we had a lot riding on this business. But I'm at the point, honestly, where I'm looking to exit. We've grown the business from roughly 9.5 million in revenue to about just under 14 now over the last 2 years. It's growing, but it's kind of, I've had some challenges in that I don't necessarily I've looked at myself, I'm not necessarily an operations guy, I've learned. I'm more an investor guy, and I'd really like to kind of let him run with it. So we're kind of in negotiations, and our family office partners want to buy us out anyway. They just bought a large manufacturer on the East Coast, and they think this would be a good fit for that business. I think they bought like a $120 million specialty manufacturer. They're looking for someone to, kind of build, basically offer another offering for what they're doing, and in addition to using the services of the business for their own equipment. So they're trying to negotiate a buyout with us at this point. My partner doesn't want to sell. I want to sell. So we're in the midst of trying to figure out exactly how to get me out of the business, so I can take my money and go do something else with it. And I don't know what he's planning on doing, but there's a 3-way negotiation going on right now. But it's been interesting. Hopefully I'll get out of there with a nice little exit, but we'll see. You never know. But it's kind of our whole goal from the beginning was to try to build this thing and then buy another company and then buy another company. We're going to do a roll up, but what you'll learn is things change, opportunities arise, and sometimes you have to be opportunistic. If someone's willing to pay you, 5 times what you invested in the business over a short period of time, might be worth, doing it. Maybe it's not. It depends on your long-term goal, but I think hopefully this thing ends up being successful for us, and we can do something else together. But that's a little bit about the business. But it's local to me, and so I do spend some time there. And as part of the investment from the family office, they required that both of us spend significant time there. They've kind of let me off the hook to a certain extent just because I'm more a finance guy, and they're like, yeah, it's not much I need to be doing there besides managing banking relationships, raising capital as needed, additional capital as needed, that sort of thing, making sure bills are paid, that kind of thing. So
what does that's awesome. I didn't know. I thought for some reason it was, I wanted to say it was in like Indiana. Maybe I don't know how I came up with that. I don't know how I came up with Indiana, but so it is close. Okay. How does that look? So the family office, obviously not everybody has access or connections to a family office, right? We're all thinking SBA loans plus, max leverage or what have you, right? How does that look from the family office perspective? Like, was the plan for them to be partners because they're putting up 85% of the capital? They need a return on that. That's a significant amount to be getting, that's a significant, imagine, I don't know what the return profile looks like for them, right?
Mhm.
Unless you do the roll up and then multiple arbitrage or something. So what does that look like from your standpoint? Do you guys did you just get ownership based on the equity you put in? Were you paying them preferred returns to try to get more equity as time went on, or how did that Just generally,
No.
you don't need to be specific, I guess. But if somebody else was to do it, how does that look when somebody's bringing in an $8 million or an 85% equity check, right? They're essentially the bank, and they probably want better
So
than
they're
bank
not,
returns.
yeah, a good question. So they're not an equity. It wasn't an equity check per se.
Okay.
So when we went to them, this was a client of mine when I worked at Morgan Stanley. And I'd done some transactions with them. I was kind of their lead banker on some of their middle market deals. And so I went to them. And this whole story started, you guys will laugh, kind of how I ended up at least getting them. But that when I started trying to raise money to buy a business, I had clients from Merrill Lynch when I worked there, clients from Morgan Stanley when I worked there, and these were all family office clients. I wasn't going to any of the large institutions because they laugh at me because I didn't work with any of them. I worked with like what I would call large and middle market family offices, and these are family offices that may have anywhere from $50 million in capital to invest all the way up to about $250 to $300 million in capital to invest. And it's usually their own family's money. So they are usually making the decision and writing the check. So when I first started out to raise capital, I spoke to maybe 30 of them that I'd worked with in the past. And all of them, for the most part, kind of laughed at me and they're like, "You're a great banker, but you have no operational experience. You're not getting $1 from me." So it just so happened this particular group, I had done enough transactions and sold them on the idea of bringing in a partner that actually knew that was pretty good with manufacturing operations, where I can kind of convince them to write me a check for this particular acquisition. Now, the way they structured it, it was more of what I would call a debt. There was a tranche for senior debt. There's a tranche for junior debt. So the senior secured all facilities in case something went wrong. They had secured debt from that standpoint. They had a junior debt to help close the gap between what they were going to provide to us and what we had in terms of capital. So obviously it's a little bit higher cost. And then on a junior debt, there's an equity kicker. So if we were to exit the business and sell it to someone other than them, then they would get, I think it was like a three turns on their capital invested or something like that, and not on the whole amount, just on the junior piece. And the junior piece was something like, I want to say it was like $2 million or something like that. So they end up walking away with $6 million in addition to getting their principal back on the other piece of it, in addition to all the interest that they would have earned on the senior and junior portion as well. So they would be sitting pretty no matter what happened. So the way we kind of, from a negotiation standpoint now at this point, and the way we negotiated this was like, look, there's 3 exit opportunities for you. Either we sell the business to you, and depending on whether they were in the market at that time, they had the right to acquire the business. We sell it to whomever, another private equity firm or another investor, and then they had the terms where they got the 3x return on their junior portion of their capital. Or at some point, we decide to refinance the business and we pay them off at an agreed upon formula. So they had 3 exit opportunities there, and so for them that reduced the risk profile from their perspective. And then the way the operating agreement was written, there's certain things that we couldn't do without getting, if we were going to look to go buy another business, and it would cost. I think the cost in the contract was, if it cost more than like $3 or $4 million, we had to get approval from them. So they had some level of control to make sure that we weren't just spending, cash flow, willy-nilly without getting some sort of approval on large items. CapEx, we pretty much had the run of the mill there. We could do what we want. But as far as other business acquisition, we had to really get approval from them from that standpoint. Management, we made all decisions around the business, and they were comfortable with that because they had other protections built in. But if you're going to go out and look for capital like that, just understand that they're going to pretty much, if they're providing the majority of that capital, they're going to dictate terms from that standpoint. But we felt like it was better for us than to actually try to do a partial SBA loan and then go out and raise additional equity capital, which would have diluted our equity ownership for the most part, and the structure just worked a lot better for us from that standpoint. But you have to be willing to sell. You have to be able to tell them exactly how they plan to exit. Some family offices are going to be very long term and they don't care. They're like permanent equity. Some of them do have an exit mandate. Maybe they have other family members that have put a requirement even on their particular family office, or their multi-family office where there's multiple families that have pooled their capital together, larger families that have pulled their capital together, and so they have someone to answer to besides just their family. So just kind of depends.
So okay, that makes a lot more sense. So it was an actual debt structure, not like them buying it and then maybe you buying them out over time or something. So
Yeah.
So how expensive is that? Like, was it compared to an SBA? So you mentioned like, you would have to give up more equity if you did I mean, maybe now there might have been options, right? But did they demand like was their return kind of more so focused towards the exit, right? With the 3x kicker, right? Or was it, because I've heard, any private capital is like 15% minimum or something, along those lines. And
Well,
then
they have a target. Yeah, they have a target rate of return generally. I mean, it's a target internal rate of return, and it can be structured in a number of ways. So, like for instance, with this
just
deal,
over a period of time, but not necessarily right.
Yeah, over this. Yeah, I mean, their target rate of return that they wanted to have for this particular deal over a period of time, and I'm willing to share it, was like 25%. And how they got there, they didn't necessarily care, but they structured the deal so that they were getting some sort of cash flow in the interim. So it was like, I think the senior debt we were paying now, mind you, when we bought this business, I think SBA rates were probably around, I want to say 8%, somewhere around in that neighborhood. So the terms that we got for this deal, because there was so much upside for them, I think we ended up coming in on the senior debt was like 6% on the senior debt. The junior piece was, I think, around 11%. The payments were structured in a way where, if we hit certain cash flow targets, we'd pay the interest. If we didn't, then it would just accrue. So they didn't want us starving the business, because obviously they wanted to see the growth in the business. So 6% on the senior, 11% on the junior tranche, and then obviously they had the 3x multiple on the junior tranche if we were to exit the business or pay them off early. And the terms of the loans were like 10 years. So I mean, they were in it for the long term from that standpoint.
And did you guys did you come up with a proposal, or did they write, like you told them?
Oh, I came up with a proposal. They just kind of laughed at me.
And then they're like, "Yeah, here, this is what we'll do."
They're like, no. This is what we're gonna do.
You're like, "Yes, sir. Okay."
Oh, yeah, yeah. When you're dealing with if you're dealing with a single check writer, just so all you guys understand this, whenever you're dealing with a single check writer, they're going to most likely dictate terms to you, and in a way that's almost better, because then you're also skirting securities law. I mean, you're not skirting. I don't want to say that because this is being recorded. You're not skirting securities laws, but you're exempt from a lot of securities laws, because if the investor can dictate the terms, then it's not typically considered a security. And especially if it's a single check writer, they're considered like institutional money at that point. They're considered smart money. So they don't have a normal investor protections that, like, if you were to go out and get multiple equity investors to come into your deal. And again, this is a debt offering too, so that's another reason it's not structured as necessarily a securities offering. You could have a debt offering that's like a private placement of debt with a bunch of different bond holders, and that would be considered a security. But in this situation, they're almost considered like a private lending institution.
That's awesome. So I always wondered. I didn't want to ever really ask. I didn't want to, because it was still early too, and it was like, So the as far as the business though, you had all these plans with the biz dev and et cetera, et cetera. So where has your growth came from? You said you're growing like 50%. So is that just kind of organic
Customer
growth? Did you guys ever do the biz dev stuff? You ever look at acquisitions, like adding on stuff, or?
No, we didn't add on anything. It was just pure customer acquisition, organic growth. we kind of expanded outside of the area a little bit. I mean, I wouldn't say it was like a major expansion. I think we expanded into like some customers in Texas, like West Texas, which was the bulk of kind of where the growth came from. We got like, I think 5 or 6 different new customers out there. We never did buy another company. We've looked at a number of companies, but you know, I just didn't like them. Didn't feel like it was a good fit. I felt like it would take our focus away from what we were doing. We were really looking for, I would say, additional capacity in the business more so than a different line. So if there was a manufacturing operation that could expand what we were currently doing, that was interesting to us. We didn't find, you know, we saw a couple of different printed circuit board companies that we just didn't like them. One was out of Michigan, and one was, I think the other one was, it was somewhere else, and maybe, where was it? I think it was in like Tennessee or something like that. Didn't like either one of them, so we never pulled the trigger on it. Or I didn't like either one of them. My partner was like, "Well, let's go take a look." I'm like, "I'm not wasting my time. I do this every day for a living. I know it's bad. I know what bad looks like." And I'm like, "I'm not dealing with this." So yeah, we never did buy another company. So it's been, you know, mostly through pure organic growth. We found a biz dev guy who's just been fantastic. A young guy who had been in business to business sales, and we gave him a piece of the business. And he's just he's killed it. Made a lot of money for himself, and I think he's 29 years old. So he's good. If I find another business, if I go into another business where it's, you know, business to business sales, I will definitely
drag him with you.
Yeah. He's one of those guys. I'll just pull to every opportunity that I have, pull him in, and like, hey, drop what you're doing, come with me. You know,
you want to make a bunch of money? All right, let's go.
Yeah, I'm like Jesus to him. You know, drop your nets, come with me. No, I'm just kidding. Don't take that literally, folks.
That's funny. Yeah. Awesome. I appreciate the transparency. I was always curious, and I'm sure other people didn't even know. So that's cool.
Yeah. Anybody else? Questions? Come on, we got 15 minutes, guys. This has been fun. James has kept me interested, kept me talking, kept me entertained. Anybody else? All right. Well, going once, going twice, going 3 times.
Hey, can you hear me, Rich?
Oh, okay. All right, Mark. What's up? I was about to hit that off button. Bye.
I know everyone's ready to go. Listen, that was a great dialogue. I just want to highlight a couple of things that you said earlier. You talked about your business and the people issues and challenges that you faced. And I've heard it kind of come up in some of the others. Where the reality is that the talent piece of these businesses is critical. If you're looking at, you know, if you've worked at a, you know, 10,000 employee company before, that talent can hide. If you're talking about 10, 20 employees, every oar needs to be in the water.
Yep.
And, you know, someone who you're paying 100% of income and they're giving you 60% of effort will be a complete drag on your business. When I talk to my seller, and we're not talking about contracts and markets and customers, we're talking about employees who are ill-tempered and get on her nerves and so forth. Don't underestimate the impact of the people issues on your business going forward. I do love the fact that Acquire believes in the people and culture element of it. As some know, my background is HR, but you're not going to get away from those issues. And understanding how to lead organizations, to lead people, to make talent decisions is going to be a huge benefit for you going forward. So it's interesting that that's one of the first things you brought up when you talked about your business, because it is a challenge.
Yeah, I never realized. And I mean, I invested in a smaller business like before that, but again, it was one of those businesses where it was a friend who convinced me to buy it, and he's like, "I'll run it for you," because he owned a larger version of that same type of business, and of course, he disappeared the first 6 months. Couldn't even find him for a drink or anything, but I never realized how important culture was to a business. So again, like I said, I was always a spreadsheet jockey looking at returns, looked at everything like as an investor. And I'm like, yeah, let me just put somebody in here. I can put somebody in there. They can take care of that. But culture is so important. And what's the old saying? Culture eats profits for lunch.
100%.
And it's especially in a small business. I mean, even in a large business, culture is very, very important. But in a small business, you know, if you don't have a good culture and a handle on what's going on in your business as far as the people issues go, you're not going to be in business for long. I mean, I've seen it with a couple of AEs who bought businesses, since we've been an acquirer. I mean, and this isn't a selling point for working with Doug's team and Ace and all that, but I've seen some people pass on it, where they could have actually, and it was enough of a business where they could have probably used it. Some businesses just don't need it because they're too small and it's just, it just doesn't make sense. But these were decent sized businesses, and they're like, no, I'll take care of it myself. I'll figure it out after I get some other stuff done. But they didn't pinpoint on that from the very get go, and they had problems right from the start. And I mean, literally, there's one guy who was an AE who bought a business in a small town, and didn't deal with those issues up front. And then you come to find out one of his best people, and it's hard to find people in a smaller area. One of his best people was like, "No, I'm leaving. I'm going to a competitor," and just walked off. And they had all kinds of problems in that business. And I don't know if they've been solved since, because I haven't necessarily talked to him, which sounds bad. I should probably follow up with him to see how he's doing. But yeah, I mean, it's important. It's probably the most important thing. The numbers are the numbers. Great. Okay. But the people make the numbers. So if you don't deal with your people issues, you're going to have a hard time moving forward. Dave.
Yeah, no, you just made me think of something too, as I'm looking at a lot of these businesses. Is there a sweet spot as far as the number of personnel the company has where you want that dedicated people and culture role versus kind of woven in, right? I mean, I know that's kind of a loaded question, but
I would almost say, and Doug probably could speak to this a lot better than I can, since he deals with it more. Because again, I am a numbers guy, a quant jock, they say. But just from my experience and seeing a number of these opportunities and dealing with them myself, I don't know. I think it depends on depends on the business and what you're ultimately trying to do with the business. So for instance, and I don't want to be mean and be coy about the answer, but think about it from this standpoint. If you're using this example, think about it. If you buy one of those FedEx routes or whatever
that are impossible to not see everywhere. Yeah.
If you buy one of those versus buying, let's just say, an HVAC company, I think the calculus of whether you need a people and culture person is going to be a lot different between the two.
Sure.
Regardless of kind of like the size of the business or size. I mean, the route's going to be the route. You're probably already going to have your FedEx people in there. There's not much you can really do with that. It's a cash flow driven business, and there's not much you can do to actually grow it. Because FedEx basically dictates what you're getting. Versus an HVAC company where there's let's just say there's male technicians and there's female technicians, and they don't get along for some reason, and no one's ever dealt with that issue. Well, in that case, then I don't care what size of the business is and the number of employees that there are. If you're planning on growing that business, it makes sense to have a people and culture person, because you want to make sure, because if that culture disintegrates, you're not going to have your technicians are going to leave, and then you're not going to have a business. So I think it's really heavily not industry, but business specific, dependent, and what your goals are for the business. If you never want to grow your business and you're buying a grocery store and you've got 3 clerks there, and you probably won't have a people or culture problem unless they're just stealing from you. In that case, you don't need one. So
yeah. So Rich, not to channel my inner Doug, but I would say a couple things to that. And I agree with what you're saying. First of all, on the FedEx one, you don't need people and culture. You might need TA, because that's a lot of turnover for talent acquisition.
Yeah.
Sorry for the acronym. But you don't need a full HR generalist for FedEx. I would say even for a small business, I would look at it from a framing of whether it's a full-time or fractional. People and culture persons, from an expense perspective, you might not need that day to day, but you want to have someone with their eyes on it so you can focus on growing the business. But also, when you think about your business and your business case, don't think about your talent strategy for business 2024. Think about your business strategy for business 2029. In other words, if you're looking to grow and scale your business, you're going to need some talent acquisition, some HR as it grows. And a lot of business owners, they think about the next quarter, not the next 3 to 5 years. And so if you're going to scale that, you want that talent on board to grow with you versus having customers knocking on your door and not just scrambling for a TA or that as well.
Yeah, and it's the other, and I'm doing this first round really in Washington State just because I don't want to uproot the family and some various factors. I think there's a lot of opportunity up here. The one challenge I find, and I popped this in the Slack channel at one point, is especially in the service-based businesses here, electrical, not so much HVAC, but a lot of the other ones, both commercial HVAC, big tent, is it's very heavily unionized. And so the company now is an electrical services company. They've been around for 30 years. Guys looking to retire, right? But it's a union shop, and it's IBEW. And I've chatted with some other folks who have either been part of the union who operate businesses now, and they said it's actually pretty good as far as that's concerned. But I know Doug mentioned back, it's like, well, you're somewhat limited potentially on building that culture and really, kind of building that environment because there is also the loyalty to the union. So I guess there needs to be a balance in there somewhere.
Yeah, I'd agree with Doug on that one. I mean, there's only so much you can do with that in that case. I mean, obviously, you hope whoever the union's sending over, is it like, are they sending over are they actually employing them and sending them to you, or are you actually employing union? Are they actually employees of the company?
They're employees of the company. Yeah, and you pay basically a little kickback to the union.
Yeah. Okay. All right. Because in some instances, I've seen where unions actually supply the employees and they provide all the pay and benefits and that sort of thing. It's almost
I've
like
avoided that before. Really, you're just at the whim of that. But the structure seems, if it is any union situation, this seems a little bit better.
Yeah. So if they're employees of the company, there's still a way to build that culture around that, because they're still your employees, even though they're under a union contract. And I think it's still incumbent upon you to kind of make sure that culture is good for your future growth from that standpoint.
100%. Yeah, the longevity of the union folks they have, I think the lowest one's 5 years and the top one's 15. So it's something's working.
Yep.
My buddy's he just got his he went through the union, he just got his electrical license. So he's in the IBEW, the International Brotherhood. He fucking hates it. Excuse me. Sorry. He hates it. He's like
so you scrub that, Andy.
he does not like, they send him everywhere. So I don't know how it works like state by state, but he's like, he's already looking for private. He's like, the union's nice because they'll, it's like a waiting list of work, right? But they can send you anywhere, right? So like he's got a small baby and they're sending him 2 hours away, and then and there's work here, but he doesn't have the seniority, so like the older guys get to stay closer, and then he's got to drive for 2 hours. But he's working a different job. He's like working project by project. So I don't know if it's there's ways you can negotiate it with them. And he's like, the unions. The bad part of the unions for businesses that use them, right, are essentially they just strangle your margins, right? So like they negotiate rates with like these government people. They kind of had the stranglehold on a lot of the commercial stuff and a lot of the, government, public, local government stuff. And so they just like strangle the margins. And, since the union workers require a certain wage, right? Like they have the mandated wages, which are good, right? But anyways, so I'm trying to get with him, like, listen, let's just buy an electrical business. We got one, we'll find one here. You got the license. You know what I mean? Like, we'll figure out
We
we'll
won't
figure
have
out how we make this
we
work.
won't have unionized people.
Yeah. You know the other side of the coin, and if we really need the labor, like there's access to it, you have the connection. But he's like, once you're a union member for life, and you can like put it on pause, but then they got to pay like all this money like to get back in, and it's like
Yeah, it's a
the
racket.
union is a business. It's crazy. They're probably an incredibly profitable business too.
Yeah.
So that's why people rallied. That's where they put all their money is all the advertising and rah, right? Join the union.
For sure.
Yeah, and that's kind of what I looked at too, is just with the negotiated rates, it's kind of the 4 to 5 year windows. It's like, all right, when's that come due, right? How bad they're going to beat down, and there's a lot of extra factors just kind of reading about it. But to your point, I think there is value that EW and probably all of them. I think they probably have those models where, hey, you're new to this, you're in a bucket of dudes or gals or whatever, we're going to send you wherever the work is, versus this specific company is their employees. And
you know where you're going to work, right? So like, if you ever switched, or if you bought a business and you're like trying to go, it's like I guarantee there are plenty of people who would prefer not to work for, what I mean? Like he's like, man, I got to find, and he obviously doesn't have the seniority, and maybe if he sticks it out long enough, and he's the guy who gets to sit fat and happy close to home, right, and making his premium weight, so like the coin flips if you play the game long enough, right? But the young hungry guys, right? He's like not fun. So
yeah,
I'd say anyone that's looking at a union-based business, though, make sure you get a good, you could, if you have a great contract reading background, that's great. But I would also get a labor attorney to review any contracts you have with the union and make sure that there's no restrictions in there on what you can do, or at least for you to understand what you can do or what the restrictions are from that standpoint. Because you could have one plan, one idea about what you want to do with the business, and then all of a sudden the union tells you, no, you're not doing that. So, so I would advise you guys all if you're going to be looking at union-based business, get a good labor attorney to review that union contract. All right, well, I think we made it to the end. I appreciate all you guys for hopping on. Yeah, it was a great session. It was enjoyable. I miss doing these things and talking to you guys, but it was fun. And as usual, if you guys have any questions about anything or want to talk about a deal, just ping me on Slack or set up a time with me on my calendar, and we can go through it. And I will see you guys all on the other side.
Later on, Rich. See you guys.
Thanks all. Bye.